Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Today we're talking about the different types of financial advisors and how they're paid. We'll also discuss the difference between fee-based and fee-only financial advisors. Ever thought about what you're really paying your financial advisor? You're not alone. I've talked to lots of people, and hardly anyone knows the actual dollar amount they're paying their advisor. Understanding what you're getting for the money is just as important. Problem is, if you don't know what you're paying, it's tough to judge what you're getting. It should be simple, but that's not always the case. Hopefully, I can shed some light and help you figure it out. Let's first look at the three main types of financial advisors. Number one, duly registered advisors. This is probably the most common way that advisors conduct their business. These advisors are registered and regulated through FINRA and the SEC. They're employed by brokerage firms and registered investment advisor firms, also called RIAs. They can earn their income by selling financial products for commissions and charge fees, usually based on a percentage of your assets. When they sell financial products, they are regulated by FINRA. And when they charge fees, they work as registered investment advisors and are regulated by the SEC. These duly registered advisors, again, can sell financial products for commissions and also charge a percentage-based fee, often referred to as fee-based, which is typically around 1% of your assets, depending on asset size. Moving on to the second type, registered investment advisors, also called RIAs, who solely operate under the umbrella of the SEC or their state regulations. Unlike the previous group, they are not associated with FINRA or a broker-dealer. However, this group can also sell life insurance and annuities for commissions, just not other financial products. So they still operate as fee-based and commission-based. Now let's focus on the third type of financial advisor, called fee-only advisors. They are also registered investment advisors, RIAs, who solely operate under the umbrella of the SEC or their state regulations. But the key distinction here is that these advisors operate on a fee-only basis. They aren't allowed to sell products or earn commissions. Their income solely comes from the fees they charge for their services. And finally, we come to number 4, insurance salespeople. They are regulated by their state insurance commissioners. If their offerings are confined to life insurance and annuities, their solutions to your financial needs will likely be life insurance and annuities. I would be cautious when considering their offerings as investments. They are obviously motivated by commission payouts and do not have to sell you products that are in your best interest. If all you need is a term life insurance policy, for example, an insurance salesperson is probably your go-to person. However, if you're looking for investment advice, they may not be your best option. In the next part of this episode, we'll go into more detail on the first 3 types of advisors we discussed. But first, a little history. Just 15 to 20 years ago, going independent reduced an advisor's value proposition compared to the big broker-dealers, as they would lack the infrastructure and support of a big firm. But tech advancements have changed things a lot. Costs dropped for tools like portfolio analysis, client reporting, trading software, and CRM software. And thanks to firms like Schwab and Fidelity, independent RIAs could outsource the custody or storage of clients' money for virtually no cost to the advisor or the client. Meaning the RIA manages your money, but your money is held in a custodial account at a large bank like Schwab. This has removed operational headaches for independent RIAs and some of the client concerns around allowing a smaller independent advisor to manage their money. So now we're going to discuss fee-based versus fee-only financial advisors. You've probably come across these two terms, fee-based and fee-only. But what's the difference? A fee-based financial advisor can charge both a fee and a commission, They often use a percentage of assets under management fee to manage your money, which may or may not include financial planning. But they can also sell products that pay commissions. When they sell products, they don't have to put your best interest first. They just have to make sure it's suitable. These advisors can be duly registered financial advisors who work for the big wirehouse firms, or who work for independent broker-dealers, or RIAs only who have an insurance license to sell annuities and life insurance. So don't get fee-based confused with fee-only. They are different. A fee-only advisor is just that, fee-only, no commissions, because they aren't selling you anything. They're here to give you advice for a fee. They may charge based on a percentage of your assets, or a flat annual fee, or an hourly fee, which often includes money management and financial planning, but not always. The fee-only model is fully transparent. This makes it super easy to gauge if your financial advisor is worth it or not, because you don't have to guess what their compensation is. Fee-only advisors must always adhere to the fiduciary standard. The fiduciary standard states that advisors must always do what's best for the client, while fee-based advisors must follow the fiduciary standard while giving investment advice. They only have to follow the suitability standard when selling you a financial product for a commission. The suitability standard means that financial advisors only have to give advice that is suitable to clients and not necessarily in the client's best interest. Now imagine your shoulder hurts. If your orthopedic doctor only followed the suitability standard, they may recommend surgery first. But since they follow a fiduciary duty, they most likely will start by ordering an MRI to understand what's going on and then recommend treatments based on what's best for you. Just like doctors, fee-only financial advisors work under the fiduciary standard and have a legal, moral, and ethical obligation to make recommendations based solely on the best interest of the client. They don't sell products and they're upfront about their fees. I believe acting as a fiduciary at all times should be the standard when it comes to giving financial advice. Their recommendations are solely focused on what benefits you the most, without any hidden motives or hidden conflicts of interest. It's important to understand the compensation structure of your advisors and to ask questions about any potential conflicts of interest that might impact the recommendations they provide. In summary, the key difference between fee-based and fee-only financial advisors lies in their fiduciary duty and compensation structure. Fee-only advisors adhere to a higher fiduciary standard at all times and are focused solely on your best interest, while advisors who can sell products for commissions and charge fees do not always have to put your best interest first. However, please note this does not mean fee-only advisors are better than fee-based and vice versa. In fact, until I started my own RIA, I was a fee-based advisor and duly registered for over 10 years. When seeking financial advice, understanding these distinctions can help you make a more informed decision, but it's just one aspect to look for when choosing an advisor. If you are still wondering what you're paying your advisor, you're welcome to schedule a call and I will help you out. No strings attached and no pressure. See below to schedule. And that's it for today's episode, and have a great day. Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.